Hey everyone, it's Jay Soloff. I'm an option coach over here at Netpicks, and I'm here to tell you about how much money you can make trading the wheel strategy. All right, so I'm here at Market Chameleon, marketchameleon.com, checking out some options analytics. I'm looking at the options chain here for SMR, new scale power. So this is modular nuclear reactors. Exciting upcoming technology. Hopefully in the next 5 years or so, we're going to be seeing a lot more modular nuclear reactors, possibly to power things like data centers, stuff like that. Anyways, it's a promising technology. There's a few companies doing this, and SMR is one of the more popular ones, trades quite a bit. So this is an example of how much money you can make on a little bit more speculative stock, right? This is a company that, of course, is not going to have a lot of sales and earnings because it's still a new technology. They're still in development phase. So it's very much speculative, which means it could be more volatile. But that can be a good thing, particularly for something that tends to be range bound. Now, if you think it's going to 0 or going to 100, you probably don't want to do a wheel strategy. There's better things to do for stuff that's going to be moving a whole ton in a short amount of time, or stay out of that sort of thing. But if you think it's going to be range bound or go up slowly, go down slowly, etc., or bounce around quite a bit but stay in a general range, that's where the wheel can really pay off, particularly with something a bit more volatile. So let's look at this. Let's look at how to start a wheel strategy. It's simple. You just sell cash secured put. Then if you get assigned on the shares, you own the shares, and you sell a call and you turn it into a covered call. If it gets called away, you sell another put, rinse and repeat, right? If your short put doesn't get called away beginning, you sell another one. If you get assigned and your call doesn't get, the strike doesn't get passed by the stock price, you sell another call, rinse, repeat. Eventually, again, you get called away, you can go back to the put. But we'll just do a simple example of selling a put, getting assigned, selling a call, getting called away, just to give you an idea of kind of a standard process and how much money could be involved. So let's look at SMR. It's trading about 36.5. So let's say we go 10 with something that's more speculative. You can go further out of the money and still get some decent premium. So this one's about 10% out of the money. So maybe a reasonable chance you don't get called away in a month, but we're going to just assume, just for example purposes, that we do. But we still collect over $1.50 here. And just for ease of math, we'll assume that's 2%, right? I'm sorry, 5%. Let's assume that's about 5%. So, $1.50 out of 3 would be 5%. So let's say we're at $1.65. That is almost exactly 5% here. So we get 5% return on cash. Let's say it drops down to 33. Again, we're going to keep it simple just for the example. That means you spent 3,300. You have to have 3,300 in your account. That's what makes it cash secured. You have 100 shares, right, for every option. So let's say we're just selling one, right? You need $3,300. So you have $3,300. You've collected, we'll say $1.65. All right. We'll do the math here at the end in terms of profits. But all right, so let's say we're at 33, and we want to sell, a call back at where we started. So we'll just round this to 36. Okay. Now this would be a month later. And obviously these prices would be different because right now it's at 36. So just to try to make it more equal, let's go above $3 above where it is now. So that's about, let's just say $2.25. All right. So we have $2.25 to sell the call. That's $3 out of the money. In theory here in the example, we're at 33, we'd be selling the 36, but let's say the 36 is worth the same as what the 39 would be. So let's say $2.25. So now we've collected $1.65 and $2.25. Just for again, for ease, let's round let's round that up to $4 between the two of them. It's a $3.90, but let's just say $4 for ease. So now we've collected $4. All right, so what happens is that if 33 goes up to 36, your shares get called away, and you've made that money up to 36. So let's say 33 goes up to 37. Whenever we don't get all the way up to 37, we get the $3 because we get capped out at 36. So now we've made $300, 33 to 36. We've made $400 between selling the two premium. So this is the most simple example. You do a whole round trip in 2 months. Obviously, you can sell puts for multiple months before you get assigned. You could sell calls for multiple months before you get assigned, but we're just going to do this in the round trip. So a round trip, the least amount of time you could spend on a round trip is 2 months. All right. So in theory, you could do that 6 times a year. So let's just say you get the same trade. Of course, it's not going to happen exactly like this, but let's just say you're able to do the same trade 6 times during the year. So we've made, again, 400 plus 300, 700 over 3,300 in cash at risk. So we'll do the math real quick here. 700 divided by 3,300 is 20%. All right. Now, that's pretty high. Again, this is a volatile stock. It probably won't be this smooth, but again, perfect, just in a perfect situation, if everything works out, that's a little over 20%. Even if not, right? Even if it takes a little bit, and let's just say you don't get let's actually make this even easier. Let's say you don't get called away. Let's say the stock just goes down, you get assigned, and then you sell the calls, and the stock just stays there. You've made 400 from premium alone. So forget the 300 from the shares getting called away. Let's just say over 2 months, you make 400. All right. 400 divided by 3,300, 12%. All right, that's a little more realistic if you don't get the shares called away. And let's just say you're able to do that every 2 months. Just sell an option, sell a put, sell a call, sell a put, sell a call, or sell all calls, or sell all puts, whatever it might be. And let's round down to 10%. If you do that 6 times a year, you're making 60%, right? You're making in this case, it's 400. 6 times, you're making 2,400 on 3,300 just for selling. Now, if it goes up, you get called away, right? Now you're making 4,200 at risk of 3,300. So now you're over 100%. Again, this is theoretical. It drops a little bit more and you lose money at first, but then all you're doing is selling calls, watching it come back up, and over time, probably shorter rather than longer, you're going to be in the black. So, let's say every couple trades it ends up being a loser, and so you only end up making, let's say it averages 5% every 2 months. Still 30% on the year, which is better than what the index is going to do. Stock index is going to do the vast majority of the time. So you could see that when you're dealing with something like this, as long as it's not a stock that crashes, and if you're going to do a little research on the stock, of course, and if you really like this technology and you assume it's going to stick around for a while, you could easily make these kind of numbers over time. Again, you can't control the market. You can't control when negative stuff comes out, negative stuff happens. We're assuming normal market conditions. Normal market conditions, you are going to generally outperform the market on something like this. You know what? But if that's not your cup of tea, you think this is too risky, you could do this on Ford or Goodyear tires or something that doesn't move all that much. Yeah, the numbers will be a lot lower, right? Maybe you'll make 15% per the year. But hey, if that's a tougher year for 15, 20% maybe. If it's a tougher year for the market, or that's actually, again, average S&P 500 return is roughly like 8 to 10% per year. So you probably still beat the market on all but good years, right? Really good years. And it's probably a little more consistent. That's what's great about the wheel, consistent money coming in. So just some examples, but you can see where the wheel can be very powerful for earning money. And so again, different stocks are going to have different results, and different environments can have different results, but you could see where it can be a good way to consistently get money and bring in income from your trades.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpicks' full risk disclaimer and privacy policy.